My name is Locke Olson. First of all, good to see you all. I'm head of enterprise sales here at YCharts. First things first, if you want to submit any questions throughout the course of the webinar, please do it using the Q&A icon down at the bottom of your screen. If it's topical, we might interject in the conversation, or we'll save some time at the end to go through any questions as well. I would also like to point out there's going to be a recording of the webinar that will be emailed to everyone. It'll also be available as a replay on our YouTube channel. And last but not least, please do keep in mind that the content of this webinar is meant for educational purposes only. It is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. And with that, Kevin, I'll let you take it away.
Afternoon, everyone. I'll echo Locke's initial comments here and just appreciate everyone joining us today. As you mentioned, my name is Kevin Lyons. I am a senior analyst with Cerulli Associates within our wealth management practice. I've been with Cerulli about 2 years now. First 15 plus years of my career, I spent kind of on the wholesaling side, a little bit of time as a product specialist. So kind of jumping over to the other side, analyzing folks that used to have my job and trying to tell them how to do it better, which is always fun when you're calling up some buddies. But lived just outside of Boston, grew up here, father of 3 daughters, so I'm vastly outnumbered at home. But, again, appreciate everyone taking some time here today. As Locke mentioned, feel free to fire some questions into the queue if they're, noteworthy and kind of make sense for what we're talking about right now. As he mentioned, we can interject, or I'll certainly pause and, leave some time at the end for some questions. And, the point of this, I think, is, as we kind of go through it Cerulli here, really want to maybe reaffirm a lot of the things that you as advisors are seeing, right? There's certainly going to be, I think, obviously some interesting things that we'll share today. Hopefully in a good way. There's not going to be a ton of novel concepts, right? It's going to kind of reaffirm a lot of the things that maybe you're seeing within your practice, a lot of the challenges that you face on a day-to-day basis, and really just kind of get a better understanding of, some of the trends that we're seeing from you and your peers. And like I said, give you a better understanding of maybe how you can be more successful and just kind of how, your peers and some of your competitors are running their practices today. So, like I said, I've been with Cerulli for 2 years now. For those of you who don't know much about Cerulli, research and consulting firm. We're over 30 years old. Really kind of break down our research into both quantitative and qualitative. So obviously we're doing a lot of research in-house, taking tons and tons of data, but then we're also combining that with in-person research calls from advisors like yourselves, national sales managers at asset managers, and really everyone in between, just again to kind of get a better understanding and really to make the data to come to life, right? You can only look at a spreadsheet and kind of pull so many findings out from that. And, that without, I think, the ability to kind of hear from some of the folks that are giving us this information that are dealing with it day to day would be incomplete. So we really try to combine the 4 main practices that we focus on: wealth management, which is my group. We also have a retirement team, institutional, and then a group that really just kind of focuses on product development. Some of the trends we'll see there. So you'll notice towards the end of this presentation, have a little bit more insight from kind of that group. And then just in terms of kind of the publications, and some of you, I'm sure, have, either participated in, or I hope have read some of these. We have our Cerulli report. These are your bigger, long form, 100 to 200 pages, 50 plus exhibits, where we're really doing a deep dive within one of those 4 practices that I just mentioned. And then on a monthly or quarterly basis, where we create our Cerulli Edges. These are more topical, more trends that we're seeing day to day. The Cerulli reports are really a lot of the same things year over year and how we're kind of seeing some of those changes. Obviously, some new themes come into play, but kind of consistency of that report. Whereas the Edge, like I said, will be more topical, will be kind of more one-off, interesting topics that are kind of, going through our industry today. And then, we kind of really try to focus, and we've seen a lot of growth within our consultative practice as well, where, we'll do everything from help teams set up a new distribution. How can they market certain products? How can advisors set up kind of a better team structure and things of that nature, and everywhere in between. So it's really kind of a 2-pronged approach. Again, reiterate a few of the things that we've seen here. worldly renowned for our sizing. We have an in-house proprietary sizing model that really helps us and allows us to get a very accurate kind of view on the industry, where advisors are coming and going, growths we're seeing in certain channels. Our advisor research and our surveys over 30 plus years in the US. Over 2,000 advisors are part of our research collaborative. So thank you, to those of you, in this call and those that have yet to join. Critical to what we do in terms of our research process. So we can't thank you enough. Really informs how we are able to kind of market and speak to some of the things that I'll talk with you today. Big on separately managed accounts. We're able to size most of the industry. And then again, some of the strategic partnerships we have out there within the industry just allow us to be more visible, kind of get in front of, more opportunities like this, appreciate kind of YCharts and things of that nature. So 30 plus years and, really excited to kind of be here today.
Yeah, thanks, Kevin. Excited to have you here and excited to share just a little bit about YCharts quickly. Really, our goal is to equip advisors and their teams with the tools that they need to save time, to make data-driven investment decisions, to enhance their relationships with clients and prospects, and ultimately to grow their practices. YCharts as a platform offers robust analytics, customizable reports and proposals, and a really user-friendly experience tailored with hands-on support that make it easier for advisors to communicate effectively with their clients and prospects and to stay ahead in what is a really dynamic market. And as you alluded to, we're really excited to partner with you and with Cerulli today for the webinar and ongoing. I think just as we here at YCharts place a lot of value in getting feedback and listening to advisors so that we can improve our offering. Obviously, you and Cerulli place huge value on advisor insights. I've personally gotten a lot of value out of Cerulli's research and reports in the past. I'm sure a lot of those in our audience have as well. And hopefully together today, we can bring a deeper understanding of some of the big industry trends going on and some actionable strategies that might help everyone here succeed and ultimately elevate their practices.
Yeah, I appreciate that. And I'll echo that. I know certainly, in my previous roles as a wholesaler and product specialist, YCharts was something I used almost every single day. So certainly appreciate the partnership and, happy to do it. I think this can be really helpful to both of us moving forward. And again, this is for you, the advisor, right? We're really interested, want to help you. You help us kind of gather our insights. So really a mutually beneficial relationship, true definition of a partnership. Last thing before we jump in, and I'll kind of show this again at the end, but I talked about our advisor survey. We recently launched our advisor research collaborative. You'll see the website there, cerulli.com/arc. You as an advisor, if you join this is where we get our research, right? This is where we're able to kind of inform the findings and the teachings that we espouse as we go across, through our reports, through our edges. And being a part of this allows you not only to help and inform our research and hopefully help your peers and kind of the industry as a whole, but it gives you some insight, kind of will provide you with key findings. There's things that we'll do on a monthly basis just to kind of keep you in the loop and give you some of the resources that, we're finding as we're kind of going through our constant research, be that through surveys, be that through reports, and certainly through research calls with some of your peers, all on a non-attributable basis. So your identity is safe with us. But again, any questions on that, I'm happy to address at the end, but cerulli.com/arc if you have any interest in kind of helping us inform our research. So I'm going to kind of break this presentation into three parts. We'll look initially at kind of some practice insights from advisor teams, how they're structuring their teams, some of the challenges that they're facing. We'll look at in section 2. And then finally, I'll wrap up with just a little bit of kind of some trends that we're seeing on the product side, be it big picture, and then maybe dive a little bit deeper into a couple of the more popular products that we're hearing about right now. So, as I kind of get into this, I do want to just, level set. You'll notice, and it does jump back and forth a little bit, but we really try to analyze a lot of our data, both through the eyes of advisors, right, to kind of get their instincts, their perspective. But we also want to look at through the lens of, asset managers, sales managers, and in this instance, wholesalers, And it's interesting, right? Some of the things that we find, you'll see completely line up. Advisors and wholesalers and national sales managers kind of see it the same way. And then there's some spots where maybe wholesalers and advisors have a little different view of how things are going. So first, we're going to look at here just some of the things that wholesalers believe. Again, we're asking wholesalers that their advisors value the most. So number one is product expertise, right? 73% believe that to be the most valuable. Beyond that, you'll look at accessibility, 55%, 39% within ability to facilitate resources. What's interesting, I think, is you look at kind of these next two, knowledge of advisor firm versus knowledge of capital markets. You obviously need to know as a wholesaler what's going on, but I think wholesalers have started to learn that advisors really want them to kind of speak their language, right? That they want the advisors want them to know what's going on at their firm within their channel. They want to know what their COI is thinking. They want to know that you've read the reports, that you know their platforms. And again, I think this is a good thing, right? Because as we're kind of seeing a trend where maybe less asset managers are kind of putting out these generalist wholesalers and trying to be a bit more specialized, the ability to advisor and a wholesaler be on the same page when it comes to kind of speaking the firm's language, that's critically important, right? And I think what's interesting here is something that, I think we'll start to see pick up a little bit too. As you look down the far right-hand side, it's that tech solutions. And the reason I think that's so low is wholesalers just don't know, right? I know from my perspective, if you could go into an advisor's office and help them with some sort of tech, be that something like a YCharts and how to run a simple comparison, or take that a step further and some sort of internal processing that you as a wholesaler or that a wholesaler has maybe learned from meeting with another advisor, that's invaluable. So I think, again, this is where one of those things where it might be a little bit skewed when we're looking at through the lens of a wholesaler, but I do think this is something that advisors would be interested in. If a wholesaler can kind of provide some of that insight and some of these tech solutions, like I said, great, opportunity maybe for something like YCharts. I'm just thinking if I'm sitting as an advisor and a wholesaler can come in, give me a quick product pitch, let me know what's going on in the market, and help me with some sort of tech, make my life easier, like that's a home run meeting. Next, we'll kind of look at, almost a similar question, but this is through the eyes of the advisors, right? And I think what's interesting here, so just to level set a little, you're going to see a lot of blue in this presentation. We at Cerulli have yet to discover, I think, any color that's not some derivation of a blue. At one point, I knew exactly how many colors were in the Crayola box. I think it's like 357. Yet we've, only chose 5 shades of blue. But the reason I point that out here is you'll notice these lighter blue boxes. These represent things that are still human to human, still, kind of create the importance of a relationship aspect of our industry. And, again, we're going to talk about technology. Obviously, YCharts is crucial, but I do still think it's important that advisors and wholesalers alike value kind of the importance of that human aspect, that relationship building. So, of course, number one is still going to be competitive product information. Again, YCharts I think can help with something like that. But advisors need their wholesalers to be knowledgeable, not just about their own products, but what the advisor's using, right? So you can be able to kind of show them how to compete, maybe show them how to complement, but advisors still recognize that as a huge value. But let's jump to kind of some of these light blue lines. Best practices from advisors, financial assistance at client seminars, access to portfolio managers, and then, pains me to say as a former wholesalers, but they don't care a ton about us actually presenting at these seminars. But again, if we kind of bucket these 4 things together, these are still the relationship aspect of the industry, right? So advisors do still recognize, as much as it's important, with some of the technology and all the things that we're trying to do to make our lives easier, to make our practices more efficient, that relationship aspect is still very important. And the other thing I'll just point out here is if you look kind of across the board, it's, do you know my practice? Can you help me with competitive product information? Can you be a resource to me? As a wholesaler, you're often not just meeting with people at my firm, You're meeting with advisors at my competitors. You're meeting with advisors at different channels. So advisors really value the ability from a wholesaler. I know I never had a meeting go by where some instances an advisor didn't ask me like, what are some of our other guys doing? Right. We would always get the question kind of as it relates to the RIA space if you're sitting in a broker dealer office, because RIAs tended to be a little bit of a leading indicator. So if we started to see trends in terms of product usage or things of that nature, oftentimes the wholesaler, might be the first one to see that. So that ability advisors really value to have that kind of relationship to kind of communicate what's going on in other areas. We've talked about the seminars. I think when it relates to portfolio construction and advanced planning techniques, yeah, I think that's important. But, as we've kind of mentioned here, I do think those are areas where more and more firms are kind of providing assistance around that. So not to say it's not as important, but I think advisors can find tools elsewhere to maybe help with some of those challenges where, again, some of these light blue boxes, right, that's the relationship aspect. So let's just kind of take a quick peek at, kind of some of the team structures that we're seeing. So this is just one example as we kind of looked at kind of how an RAA team may structure itself. Again, this isn't the only way. At the end of this presentation, I have a couple different archetypes, but this is just one example of how they might set it up. If you look on the right-hand side, I think what's interesting here is we pair, again, that blue dark blue with RAAs over 500 million, and then that light blue will represent all RAAs. So the first thing that you'll notice on the left-hand side there is, almost 2.5 times more RAAs that have over 500 million are employing some sort of financial planning, power planner. So again, if you go back to the challenge of the previous page where, advisors are telling us that that's one of the things that they could value. Well, having a larger team, you tend to see more ability, a larger practice to have more resources in-house, right? And kind of maybe help mitigate some of those challenges. The same is true when it comes to a research analyst or some sort of CIO type role, compliance professionals. The point is these larger RAAs that have a larger or more AUM, they just have the ability to provide more resources and be more holistic in their approach to clients. And that's critically important, right? I mean, I think more and more today, clients are looking for that all-in-one approach. I don't want to just have you be my, stock broker, as we used to say. It needs to be more inclusive beyond that, beyond just investment planning. So we do kind of see that set up when it comes to some of these larger RAAs. Why is that the case, right? So this, we're just not necessarily looking at RAAs. This is all advisors as a whole. And in this instance, is we're just looking at a solo practice versus a team-based. So you see some of that kind of RAA flow into this as well. But you look at a team practice, and the reality is more AUM leads to more services, right? So if you have more services within that, not only in most instances will you have more clients, not only in most instances will that lead to a higher AUM, you have more staff members, you're going to see more services offered, things like succession planning, practices with junior advisors, which not only contributes to that succession planning, which I will touch on later when it comes to challenges, but also to help kind of carve out and segment a book of business, which will not only help you as an advisor grow, you're going to be grooming either a successor or a partner, right? Which again, I think, as you can do that, it's only going to be free up more of your time, allow the practice to become more efficient, and allow you to focus on the things that you need to do, which is new client acquisition, right? That's the thing that we hear all the time, regardless from advisors, whether the market's up, down, all the tech in the world. I'm in a wirehouse, I'm in an RAA. It almost doesn't matter. The biggest issue, the biggest challenge is always finding new clients. So the ability to have more services offered, have that team-based approach allows you to free up your time to be more efficient and things like that. Focus on the time, or focus your time where it should be spent. And, what does this lead to? Not shocking, right? If you see advisors that have more AUM tend to have a larger team, advisors with larger AUM with a bigger team tend to offer more services. Not a shock to see that those are the types of teams that are dominating market share across channels. So in this chart, the dark blue Again, that theme. Bars will represent the amount of AUM. On the bottom, you notice we break it down into 5 different channels. Wirehouse, that 70, or excuse me, that 70%, while may seem the wirehouse at 70% with such a high AUM is pretty significant, right? You notice kind of that high net worth focus. So as advisors are trying to grow their practice and maybe get more and more of those ideal clients, this is why, right? If you have a larger practice, you have a significant share or market share of every channel across the board. So dark blue bars, the actual assets, the lighter blue trend line, that represents the percentage of market share. So even in the national regional VD and the independent channel where it's just under 50%, that's still a pretty significant number. And then again, in the wirehouse, almost 3/4 or 70+% market share with those teams over 500 million. Hybrid RIAs, obviously a huge growth in our industry most recently. Almost 90% of the market share is from teams with over 500 million. I mean, that to me is staggering. Hard to not kind of jump out with you. And this is just kind of reiterating all the points that I just said, right? Practices with more AUM, more financial planning services, something that there's a huge appetite from that we hear from clients across the board. I need more planning. I don't want just a stockbroker. So your dark blue, that represents practices with over 500 million. Lighter blue would just look at all advisors as a whole. So again, some of these things, like every advisor or most practices are going to have some sort of retirement income planning, right? And that's true of giant practices. That's true of the smallest practices. What's interesting, if you look kind of towards the far right-hand side, that intergenerational planning, right? You want to maintain a practice and consistency the same way that advisors are building out your own team with junior advisors and kind of creating your succession plan. Well, you want to do the same thing as an advisor when it comes to your pipeline. So to be able to communicate with that next generation, to be able to communicate with the, children and in some instances, grandchildren or some of your best clients, that's the best way to kind of keep the ball rolling to maintain that efficiency. So that's something that's much more significant with these larger practices. Things like estate planning and trust services. Again, the ability to attract some of these high net worth clients. These types of services are almost essential, right? So if you have a larger team, if you have more AUM, we're definitely seeing those types of advisor practices having the ability to kind of reach some of those high net worth clients because they just tend to offer more of these holistic planning services than your typical all advisor pool. And then just kind of wrap up section one, and then I will pause for a second here to see if anyone's jumped in the queue. But we're just kind of looking at, how technology and kind of impacts different practices by technology type. So what's interesting to see here is, again, these blues. In the dark blue, a light user of technology. I'll call it baby blue, maybe royal, a medium user. And then in that, I've been calling it seafoam green. No one's corrected me yet. But that top bar, that's a heavy user. So you'll kind of see as you go across the bottom from the AUM of these practices, as more AUM kind of goes under into these different practices, the heavy usage of technology picks up. Why is that important? A lot of the things that I've mentioned before in terms of efficiency, but the reality is here, when you're able to utilize technology to become more efficient in different areas of your practice that, maybe are more of a time drain, ultimately what it allows you to do is spend more time with your clients, right? And again, at the end of the day, it's spending time with your clients, it's having the ability and the time to find new clients. The more technology, the more things like YCharts that you can implement into your practice that allows you to become more efficient in those areas. Ultimately, what it's doing is opening up and freeing up your time to do the things that are most essential to kind of growing and creating a most optimal practice. So I will pause for a second, Locke. I don't know if there's any pressing questions just yet.
Doesn't look like yet. I will buy your seafoam green though. I think you're right there.
I appreciate that. Now I'm rolling with it for at least a year until someone tells me otherwise. So no questions. So all right, we're perfect so far, Luck. First inning through. So now let's look at kind of again, kind of some of these practice challenges. So I've alluded to this. I know this is not going to be a novel concept, but this for this survey, we did ask advisors, what are the greatest practice challenges that you face today? So again, I don't think anyone will be shocked to see that new client acquisition is number one. Maybe at some point that'll change, but I don't think I've ever seen this question in really any form where you don't see the biggest challenge that advisors face. Uh, Being new client acquisition, right? Every day, every month, it starts over, and you constantly need to be grinding to do that. A critical component, obviously, to grow your practice. Hopefully, kind of section one allowed you to see kind of some of the things that you could do or could try to do to make that process, if not easier, at least allow you some more time to focus on it than being bogged down by some of the stuff that doesn't allow you to grow your practice, that doesn't allow you to find new clients. Compliance is always going to be a challenge. Hopefully, I think more and more wealth management firms are recognizing this, and I say hopefully are continuing to kind of provide more services to make advisors' lives easier around that. But that's still a big challenge. And then I'll kind of combine that multi-generational and succession planning together because like I said, I think that's almost the same thing, right? If you're doing the same thing with your clients in terms of finding and identifying that next of kin to really kind of maintain that relationship longer term, you want to be doing the same thing with your practice, right? So those are still a couple challenges. And like I said, I'll go a little bit deeper into succession planning a little bit later. And then tech is still huge, right? I know we've kind of been talking about that quite a bit here, but be that internal tech issues, be that just things that, tools like YCharts or other kind of optimization techniques that help you with product information. It's still a challenge for advisors, right? I think, as we're slowly getting a little bit younger in the industry, and as younger advisors come in, by default, they have a little bit more expertise with technology because really that's all they've known. Of course, it's going to be a little bit more challenging for more experienced, more senior advisors because the reality is a lot of these tools just didn't exist. And, most of them figured out a way to be very successful without having these. So that can tend to be a little bit more of a challenge. But I do think as more folks that are kind of coming into the industry that's all that they've known, we might start to see that fall off just a little bit.
Hey, Kevin, if I can, on that last slide, just a few of these really jumped out at me as I was looking over this deck. And it's interesting from my perspective because we think that YCharts is kind of an all-in-one platform is a great solution for RIAs trying to solve a number of these challenges. Just to call out a few specifically, I think, the new client acquisition one, obvious, but we're hearing every day that organic growth is an issue and a challenge for, I would say, large and small RIAs that we work with. And it's really somewhere where we see some traction in the market right now as a product with our proposal tool as being able to add a ton of value. Number one, we're saving advisors a ton of time because our tools are really easy to use and they drive efficiency, and you can reinvest that extra time back into prospecting efforts and sitting down and trying to gain wallet share from existing clients. But you need a great tool to articulate the value that you're adding on the investment side of the practice. And YCharts does just that. And it actually ties into that second last one, being able to differentiate your practice and define your value to your prospects and clients. We've got some really cool tools in our report builder that drives our proposal generation system that basically allow firms to incorporate proprietary firm material into the proposals and deliverables that they're bringing to a meeting. So talking about things like their investment philosophy, their team makeup, the history of the firm, how they go about the financial planning process, holistic planning, all of those things can be embedded into the reports and proposals that you generate out of YCharts. And then just quickly on a couple of these other ones, compliance has been a huge headache, I think, for a lot of folks in the industry, thanks to the SEC marketing rule. We've kind of stood out, I think, in this category because we've implemented a number of different solutions, no matter how you interpret that rule, to make sure that the proposals or reports that you're showing to clients, whether or not they show hypothetical performance, are buttoned up and comply with that rule. And then one of the ones in the middle here, optimizing your portfolio construction process if you need help with that. I mean, YCharts is a phenomenal tool. We literally have a portfolio optimizer that can help you navigate that process.
That's a great resource, right? When you think about, this is coming from the horse's mouth. These are the biggest challenges that advisors are telling us. And to Locke's point, obviously, it seems like YCharts, can help with a lot of these areas. Again, optimize your practice, make you more efficient, allow you to kind of free up time to do what's most useful to you and your practice. So this is a question that we asked advisors, just in terms of why they may or may not, quote unquote, terminate a relationship with an asset manager. And, I think just to note here, this is the percentage that advisors identified as a very important reason that they may identify in terms of termination. So I think what's interesting to see here, and I know, kind of advisors, I understand where you're coming from. Poor client service, of course, right? If you don't have, good experience dealing with an asset manager, be that on the smallest of things, how can you trust them on the biggest of things? So that's consistently been at or near the top when we ask this question year over year. I think the volatility is interesting. I know from my perspective as a wholesaler, right, that was really challenging for advisors to kind of handle. And you understand why, right? If you can't kind of come to have some level of expectation or consistency, um, in the ability to kind of communicate that to your clients, right? It's really hard to kind of stick with an asset manager that continues to have that volatility. Fees obviously critically important. Change in investment style, that's something that kind of it's interesting year over year. Sometimes that pops up. It kind of depends on the flavor of the week where, in our industry, sometimes we love flexibility. We love stuff that can go anywhere type strategy. And then we kind of swing back the other way. And, if I want a large cap value ETF, that better be a large cap value ETF. So that's one of the ones that kind of does change year to year. To Lauk's point, if you're not helping with portfolio construction, oftentimes advisors kind of hold that against you, right? So, in an instance like that, where you can have a tool like YCharts to kind of help with something like that, that may allow you to stay with a firm or a product that you do enjoy or do utilize and works well for your clients. But maybe they're not providing this. If you can kind of do that on your own, that kind of helps alleviate some of those concerns. And again, it's just interesting because, when we ask this question, like I said, the volatility, client service, and fees to a less extent tend to be at the top. Those next kind of three or four are always a little bit different. And I think that's somewhat dependent on kind of what we're seeing in the market and trends of today. So this we're looking at kind of the challenges for advisors in terms of productivity. And again, this is a theme that, both Locke and I have touched on in kind of ways that maybe you can help alleviate some of this. But the reality is, so again, dark blue will be not a challenge at all. Lighter blue, a moderate challenge. And as Locke confirmed, seafoam green will be a major challenge. So by far the biggest thing that advisors are facing in terms of bogging down their productivity, serving too many non-ideal clients. What's interesting about that, I think, is, if we go back to kind of the beginning when we're talking about, when I was talking about, I should say, kind of some of the team structures we're seeing and some of those larger teams with more services. One of the easiest ways that an advisor can serve or can spend less time serving their non-ideal clients is to have that smaller group below you, or so I should say that junior group below you, right? Where you maybe have a junior advisor that can take some of these, quote unquote, non-ideal client. And a non-ideal client, in some instances, maybe the nephew of an ideal client, right? So I think that we purposely kind of ask these questions and leave them up to open to interpretation. So I think sometimes, non-ideal can be misconstrued, but the ability to kind of have a larger team not only will help you with that biggest productivity challenge, number one, it'll help with number two as well. Part of the ineffective delegation to staff is the lack of staff, right? It doesn't say that on this question here, but anecdotally, when we're having some of these research calls with advisors, typically that's how they kind of interpret that is, I don't have a staff to delegate to, right? Or I'm wearing so many different hats that I can't do that. So that's something that, close to 90% or 90% of advisors have that as least a moderate challenge, right? So I think that's pretty significant. Process documentation, again, that's something I think dependent upon the advisor, depending upon the team size, service offerings across all clients, and then the tech tools as well. So, I think a lot of the things that we keep harping on here, I don't want to say can be immediately solved because that's a little too me jumping to a very easy and quick conclusion. But a larger team, if you can offer more services, if you can utilize some of these technology tools to become more efficient, a lot of these productivity challenges, if not washed away, can maybe be alleviated some, again, to allow you to be more efficient and focus on the things that you want to focus on as an advisor.
Had a question come in that might be relevant, Kevin.
Yeah.
Someone was curious if this segmentation data is or has been cross-referenced by team size.
So we have all this data. We break it down 100 million different ways. I don't think any of our outward publications have this broken down by AUM, but we have it somewhere. My inclination would be kind of a lot of the themes that we've seen so far in terms of those larger practices compared to all advisors would kind of hold true to this. But yeah, you can pass me along that name. I'm sure I could find the actual raw data that we have on this because the short answer is yes, it just may not be published.
Great. Okay.
So this, I think, I actually love this visual. I'll pat myself on the back. I created this slide. It's very simple, but I just think it does a good job of kind of explaining, I think that the biggest thing that we've seen when it comes to, how are these larger teams with more AUM more efficient compared to just all advisors as a whole, and then obviously more specifically or, less specifically, um, advisors with our practices with less AUM, but I think the bullets are noteworthy. If you look at advisors with more than 500 million, so on the far right-hand side of the bottom, again, dark blue, we're looking at client-facing activities. We mixed in, I think that's a royal blue, which will be administrative. Light blue is going to look at investment management, and then that seafoam green professional development. But if you look at advisors with more than 500 million in AUM, they spend 2/3 of their time in client-facing activities versus only 50% of the time with advisors with under 25 AUM. Obviously, that's a pretty wide swath, but we do kind of illustrate that just to kind of harp on that point. And then same if you're looking at advisors with less than 25 million versus those larger practice, they're spending twice the amount of time on investment management. Again, disallowing them from kind of spending more time where they should be focused on in terms of client acquisition and servicing their current clients. Administrative tasks, ironically, doesn't really change at all when it comes to practice size. But the reality is advisors and practices with more AUM, because they have more services, because they're more holistic, they have more time to focus on what's important, less time spent on investment management, partially because they might be using technology tools like YCharts and things of that nature, but they just have more time to do the things that are most critical to growing their practice, new client acquisition, intergenerational planning, and spending time in servicing their current ideal clients. So as we kind of continue with challenges in this section two, one of the big things that's really coming up more recently is kind of the succession planning or maybe lack of succession planning when it comes to kind of advisors. And we're expecting that kind of transition phase to really uptick over the next decade. So this is just kind of a level set, right? You look at the average age of an advisor today is just under 67 years old. We look at in the next 10 years, over 100,000 advisors we expect to transition. That's almost 40% of the industry. So there's going to be a lot of turnover, a lot of factors for that, which I don't think we necessarily need to get into today, just in terms of timing of the industry, some of the DOL stuff. I forget the exact number, but I remember, looking back at like the amount of Series 7 folks taking the Series 7 has like greatly diminished year over year. So as our industry is not only aging out, you're seeing less people coming in. So this is pretty significant. And, those less than 40% of advisors represent over 41%, 41.5% of the industry assets. So just a level set once again, over the next 10 years, we expect more than 40% of industry assets to be in some sort of transition, right? Um, which is interesting. And I misspoke. I'm sorry. The average age of an advisor, that's the average age of advisors expected to retire. The average age of the advisor is 49. Hopefully, there was a few audible gasps that I didn't hear when I told everyone that the average age of an advisor was 67. That's the average expected retirement age. Average age today is just under 50. Um, and the reality is, of those kind of massive amount of transitions and massive amount of assets that we think are going to be happening over the next decade, over one quarter of advisors are unsure of their succession plan. So on this chart, again, you'll notice your lovely dark blues and light greens. Disregard the kind of shaded box for now. In a longer form, I could walk you through this in 10 or 15 minutes, but I think for our purposes today, a couple things that really stand out to me. Far left-hand side, if you look at just all advisors, 26% of them unsure. Literally don't know what they're going to do in terms of their succession plan. That's pretty noteworthy when you kind of put that in conjunction with the amount of assets and the amount of advisors. So call it 30,000 advisors of those 110 that we expect to retire over the next 10 years just don't know what they're going to do. If you look at the wirehouse, yeah, wirehouse advisors tend to, just by the setup and the structure of a wirehouse, tend to have maybe a team or a junior member of their team or a partner of their team. That makes it a little bit easier to transition. So oftentimes we see that as the most likely scenario. Um, when you look at the independent channel, that tends to lead more likely to an external sale. When it comes to the bank channel, you're going to most likely be reassigned to that next bank broker. But again, more than anything, it's hard, right? And advisors are dealing with this every day. And as we see more and more folks kind of approaching that retirement age, this issue is only going to become more prevalent. So that 26% is noteworthy. And the reason why we kind of look at here. So we asked advisors, what are the biggest challenges when it comes to transitioning? So seafoam green, not a challenge at all. Royal blue, moderate challenge. Navy, navy, a major challenge. What's interesting is, 95% of advisors just below, the biggest challenge for them is just the emotional aspect. So I think that's great, right? I kind of jumped out at me when the first time I saw that. It's like, okay, good. Advisors are actually, they do care about their clients. They're most concerned with kind of maintaining that relationship. And someone that they've worked for, in some instances, 40, 50 years, they want to make sure that they're taken care of ideally in the same manner that they had been for those previous, 30, 40, 50 years. So that's the biggest challenge advisors are facing. It's like it's in the heart, it's emotional. So I think that's important. Then we kind of get to the nitty gritty, right? It's hard to find a qualified buyer. Like, how do you do that? Or how do you value your practice, which is kind of the third challenge. And again, not only are these things difficult, firms have, or asset managers and wealth managers have come a little bit around on this, and you are starting to see kind of more succession planning services. But ultimately, there has kind of been a lag when it comes to kind of service offerings from your own firm as an advisor. I would argue that kind of some of the things around succession haven't been as widely or readily available as maybe some of the other things as kind of trends have jumped in front of this. So the biggest takeaway from this is a lot of advisors are expected to transition over the next 10 years. One quarter don't necessarily have an idea of what they're going to do when it comes to that transition. And the reasons why, it's hard, right? It's hard to find a qualified buyer. It's hard to think about, maintaining or how a relationship for someone that you've really worked with, seen their kids grow up. how to maintain that same relationship with their next advisors. In a great way, advisors really truly care about that. I didn't even mention the tax portion of it. 95% of advisors consider that at least a moderate challenge, right? So these are all things that are top of mind. And again, as more and more advisors are transitioning over the next 10 years, this is going to become much more prevalent in our industry. So it'll be interesting to see kind of how this develops and how it plays out over the next 5 to 10 years. All right, I will pause for a second just to make sure we don't have hundreds of questions in the queue.
Looks all clear right now.
All right, we're 2 for 2. Um, so just to wrap things up here, kind of in this final section, talk a little bit more about some of the trends we're seeing in product. And again, most of this is high level. I'll jump a little bit deeper into a few different areas, but really just kind of want to paint a picture of some of the themes we're seeing. A lot of this might be reaffirmation, right? And kind of, you know, reaffirming a lot of the things that you're seeing and doing today. I know Locke touched on this a little bit, but it's interesting to see here. We took a look at kind of how portfolio construction is evolving, right? And again, this is not your 1980s stockbroker. There's a lot more tools and things available, be it externally through something like YCharts, be it from your own firm as an advisor. So here we kind of break down how advisors are typically kind of building out their portfolios. The two top reason or the two top answers, I should say, custom portfolios for each client and models developed by their practice, right? So these are both internal, kind of, we see the main influence there. These are driven by the practice, right? Just below that, we'll start with a model internally built by your practice, and then from there, alter it as necessary, right? Whether you tweak around the edges, you add a hub and spoke approach, etc. But the top three ways that advisors are kind of constructing portfolios today are all internal. From there, you're starting to see a little bit more trend where things provided by your broker dealer or custodian are kind of becoming more prevalent and more popular. So models that come from BDs at 15%, models suggested by a BD at 13%. So you're starting to see a little bit more influence. And then again, this is something I bet if we showed you this chart 5 years ago, that third-party model would probably not even be on the chart, may not even have been an option to respond. But we're starting to see a little bit more exposure, especially in the RIA space, of kind of different ways that advisors are really trying to be more efficient in their portfolio construction. Again, doing things that allow you to become more efficient as an overall practice and focus on that stuff that we talked about earlier, new client acquisition, things of that nature. But if we kind of look at it big picture, 60% when it comes to portfolio construction is being built or quote unquote influenced by that internal practice of the advisor. 28%, a little less than 30, being influenced by your custodian or broker dealer. And then 12% is kind of coming from that third party influence.
Kevin, if I can jump in on this slide as well, I found this one pretty interesting, and it's definitely, we see these trends all the time. I would say YCharts is a phenomenal tool no matter how you're choosing to implement YCharts, or sorry, models within your practice. For advisors that are doing it themselves or practices that are doing themselves, obviously we offer a ton of tools to help you create, adjust, track changes to your models, and ultimately position them to prospects and clients. But I would also say, I think, especially on the enterprise side of things, a lot of our best enterprise implementations with large RIAs and broker dealers is really using YCharts as a delivery vessel for their model portfolios, arming the advisors in the field with not only up-to-date information on those models, but also really powerful tools and visuals that can help them articulate the benefits of those strategies, be able to evaluate up-to-date information and data on those portfolios, and then ultimately compare them maybe to like a prospect's existing holdings in a proposal and win new business and ultimately drive business and assets to those proprietary strategies.
Yeah, appreciate that, Locke. Again, just becoming more efficient, right? Let's use the tools that are readily available to us, that can help us be better and ultimately do what we need to do and what we need to focus upon as advisors. So this shouldn't be a shock to anyone. We're kind of looking at, or we are looking at the we ask financial advisors use of allocation to certain investment vehicles. So on the far left-hand side, we have that investment vehicle. That next number is just the percent of advisors utilizing it, right? So just very simply, like, do you use mutual funds? So not shocking to see, right? 94% using mutual funds, a little over 90% using ETFs, just under using individual equities. What I think is more interesting is kind of that trend line. So if you look to the far right, we see where we stand today, 2024, in terms of the vehicle allocation, right? So not just do I use it or not, what percentage is within my overall investment setup. So, right, you'll still see mutual funds on top, 28%, right? There's still a significant number of mutual fund assets in the industry, and they're not going away. 21% are in ETFs. What's interesting to see there is essentially, if we look at kind of our projections over the next 2 to 3 years, you're going to see mutual funds come down by about 5% and almost single-handedly replaced by ETFs. That shouldn't be shocking to anyone kind of, I think on this call, but it is interesting to see, when we'll kind of have that crossover point where we're starting to see, not just people talking about using more ETFs over mutual funds, but the actual allocation of such. And then I'll also, there's a lot of stuff in the middle that I'm not going to touch on. I mean, you can see it there. I don't think anything is like super jump out that kind of deserves much more beyond. But I will kind of point out at the bottom there, separate accounts and alternatives. Um, we're starting to see more and more separate accounts, right? We're starting to see different ways, different asset managers that are utilizing separate accounts, and then alternatives. So even though those projected increases aren't very significant, especially when it comes to the alternatives, when you're going from 2.3% to 3%, like that's actually a pretty significant jump from kind of that low level of a base. So, percentage wise in terms of growth, that's actually more significant than we're seeing in terms of ETF growth, right? It's just starting at, obviously a significantly lower asset base, but alternatives, as we know, are not going anywhere. I'm very interested to see how this chart looks, in a year and 2 years from now, in terms of kind of where we stand in terms of, the actual percentage of allocation to things like alternatives and separate accounts, and then, kind of our projections at that point. So again, mutual funds are going down, not shocking. ETFs going up. We're really starting to see a pickup in separate accounts and alternatives, and those are certainly going to be a bigger part, and more advisors are using those every single day. You won't be shocked to see this as well. This is, I talked about kind of that crossover point. So, here we look at just the breakdown of advisor allocations to ETFs over the last 10 years. As we just looked at in the previous chart, 21 to 24%, we expect over the next couple of years. $8.2 trillion in assets, 600 billion in flows into ETFs in 2023, right? Which is, I think, are staggering numbers to look at. And again, the reason we have that kind of light blue in 2025, that's the crossover point, right? So that's when we do expect ETF assets to jump past mutual funds. Again, we'll see when that happens. The projections are just that until they do or do not happen. Be interested to see as we kind of continue that trend of ETFs, or excuse me, as a trend of mutual funds versus ETF allocations kind of going in that opposite direction. Just in terms of kind of why we're seeing that, I think if we look at kind of these ETFs, so here we looked at ETF issuers and kind of asked them some of their biggest focus when it comes to new product development. Fixed income is huge, right? We're seeing more active fixed income. We're seeing more transparent fixed income. But the biggest thing we're seeing across the board, almost 90%, or I should say a little over 80% of issuers are saying U.S. taxable fixed income is at least a secondary focus, if not a primary one. You're seeing some of the thematic, I think, coming more into play where, maybe taking advantage of some of the trends or some of the themes that we're seeing in the industry. But when it comes to issuers, when it comes to new product focus, fixed income is really driving that. we touch on this, or I touched on this a little bit just in terms of that low number to alternatives. It's interesting right now, they're currently low, but I think the reality is if you look at kind of the way alternatives are set up, it's challenging. And I think the biggest thing that we've kind of learned from having conversations with asset managers, so here we look at kind of how advisors are actually setting up their alternative assets by different structures. And the reality is, a lot of the things on this page, while becoming more prevalent and more popular, they're a little scary to some folks, right? It's not something that maybe traditionally you dealt with at all, call it a decade ago. And the reality is obviously just not as much as we certainly are today. So I think the biggest thing that we've heard from asset managers in terms of helping advisors is how can we be more or how can we educate our advisors better on all of this stuff, right? Whether it's the particular asset classes that are within the alternative space, kind of the expectations of consistency or lack thereof. How can they communicate that to clients? Because again, as we know, be it as a wholesaler or any sort of asset manager, if your message to the advisor cannot be easily translated to their clients, it's useless, right? It falls on deaf ears. So I think that educational aspect of the alternative space is something that we hear from asset managers they're really trying to focus upon when it comes to helping out their advisors. As we know, we're going to see more and more folks utilizing these types of strategies. And then when we looked at it kind of from advisors, like, why are you using it today? What are the things that you're looking for from alternatives? It's a lot of the things that we talk about, when it comes to most asset classes, but ability to have more diversification, limit that volatility, kind of have a better downside protection tool, inflation, income. Again, I think it's just a way for you as an advisor to differentiate yourself. If you can kind of show how you can utilize something that maybe the guy next door or the lady down the street is not necessarily using to maybe attract some of those high net worth clients, which, as we know, kind of larger practices, more service tend to attract some of those high net worth clients. Alternatives tend to be something that's a little bit more attractive to those types of folks. So when it comes to advisors, this is what they're trying to get out of alternatives. And again, as asset managers can kind of continue that upgrading of education and helping advisors to really be able to communicate these benefits or, kind of ensure that these are the types of things that they should be speaking to with their clients, it's only going to help and increase that kind of growth of the alternative space as a whole. I won't go too deep into this. Just know that this is kind of reaffirming what I just said, right? The ongoing education asset managers have recognized like that's the biggest component that's going to help with more adoption from advisors, right? Until they kind of know or can maybe alleviate some of these challenges or concerns that they speak to, and oftentimes, most of these things just kind of are all under the umbrella of lack of understanding or kind of difficult to understand. So education is ongoing. Asset managers recognize this. Advisors have told us this, like, I need to know more. I need to have a better understanding of how these products work, so I can communicate that to the client. So I do think we're kind of at an inflection point there where both asset managers and advisors recognize, hey, the more I know about this, the more I learn here, the better I'll be able to communicate this to clients. Part of the reason why, though that small percentage point growth, large kind of coming from such a slow asset base over the next couple of years when it comes to alternatives. Lastly, real quick, and then I'll throw it back to you, Locke, if you have anything to add or jump back to the slides. You may have seen this one before. I'm going to show it again. Our advisor research collaborative, cerulli.com/arc. Love your input. Love to help for you to help us kind of inform, make my presentations better, and just kind of get a better understanding of the things that, you as advisors are dealing with on a day-to-day basis, challenges, product usage, all those types of things. And, for your benefit, we'll kind of help you give you a better understanding of what we're hearing from your peers, what you're hearing from your competitors, and kind of some key findings that we see on an ongoing basis to help kind of inform and ultimately help to optimize your practice. That's all I got. I appreciate it, Locke. I'll send it over to you, sir. And thank you ever again for your time.
Yeah, thank you, Kevin. Great stuff. Really, really compelling information. You did such a good job unpacking the data. We don't have any questions right now, but lots of valuable insights obviously in here. So thank you again for joining us. Thanks to Cerulli and thanks everybody who was here in the audience. We appreciate your time. Hope you have a great rest of your day.